Hey folks, it's Rob Flux here from Property Developer Network coming to you for another Sunday session. This time we're talking all about how to move from employment to full-time property development. Now, it's a topic that many people ask about all the time, I guess, and the ever elusive financial freedom terminology always seems to come up. And I guess this is where I want to try and set the record straight because how many times, let's face it, how many times have we seen some spruiker standing in front of a Learjet, Ferrari, McLaren, Porsche, or something like that with some sort of get rich quick scheme? See, the truth is that it takes quite a lot of work and there is no get rich quick, but there is get rich slow if you put the time and the effort in. Okay. So, what I'm going to do today is I'm going to try and walk you through the methodology that I use and teach within our property development formula program to try and give you the insights in what you need to do in order to transition, some of the things that you need to think about, some of the challenges that you're going to face along the way, and hopefully how you can actually build the resilience to, I guess, do this for yourself, okay? We tend to put this together in what we call a 5-year property action plan, and I'm going to give you the insights into how we actually put that together right now. Here's the thing, okay? Real wealth is actually not I guess, a Learjet or a mansion or a fancy car or anything like that. Real wealth comes from passive income. And what we want to do is we want to accumulate enough positively income geared properties that it generates enough cash flow that it pays all of our debts. Now, if it can do that, if it can pay for the fuel in our car, the food on our table, I guess the electricity bill, send the kids to school, all those sorts of things, if it can pay that, then we are technically financially free, okay? But there's a couple of steps that actually happen along the way. So there's one which is financial independence. So financial independence is where we actually swap our day job for our property development job. So we are no longer employed, for want of a better, I guess, terminology, but instead we're able to actually cover all of those expenses through our own sweat equity. So we've effectively swapped one job for our property development job, and we're able to replicate, I guess, the amount of income that we might have had along the way, and that then buys us the time to be able to do this full time. Okay, so it's a little bit of a staged process, and then true financial freedom is having enough passive income to cover your debts. Okay, now if you have enough passive income to cover your debts, then time starts to become on your side. Time. You don't need to go to work because your debts are actually covered. So now you can choose whatever it is that you want to do with time, because you see, time is the most valuable asset that you're actually going to get. It's the only thing in life that you can spend and you never get to get it back. If you spend money, you can earn that back. If you spend resources, you can get those back. But time, once it's gone, it's gone. So we're going to try and give you the insights and how you can fast track that as quick as humanly possible. So there's 5 stages that you need to think about on your financial freedom journey, okay? So stage 1 is solidifying your development strategy and then learning your trade, okay? So this is learning the skills that you want to execute on your chosen development strategy, trying to build yourself a plan in how you're actually going to get those skills. And you want to start to get enough money at this instance that you can actually I guess, duplicate your current wage, okay? And it's important I say duplicate, because what we want to do is not have you leave work too early, okay? We want you to, I guess, have your day job, and part-time, we want you to duplicate that. So effectively, for that period of time, some people call it a side hustle, but for that period of time, you have now doubled your income for that particular year. Now, if you can do that, it now starts to build a little bit of a nest egg for you. And that nest egg is something that you're going to need in your future stages of the process. Now, ideally, you want to do that at least one time and preferably 2 times to kind of build that nest egg relatively significant before you actually make any decision to move on to stage 2, okay? So stage 2 is where you swap that day job for your property development job. Now, at this point, you are technically financially independent, okay? You are using your property job, okay, to pay for your bills. Now, the problem is the property takes a while. When you do property development, it takes a while to A, find the deal, and B, to actually run the project and get paid at the tail end of it. So during this process, you actually have a burn rate. Okay, so you're actually starting to burn your cash resources because you don't have anything. You don't have a regular wage to actually come in every week. So you need to understand what your burn rate is. And we're going to talk to that in a couple of seconds to understand what that burn rate is and also how to actually determine what that financial freedom number is. Okay. When you understand what that burn rate is, then what you have to work out is the kind of projects that I'm actually doing. Is it going to A, cover my burn rate? So if, for example, my project is going to take 18 months to execute and I've got a burn rate of 80K per year, then I've burnt 120K in living expenses before I actually get paid. So I want to make sure that the project that I'm going to go into at least pays me back 120 to replenish, I guess, the kitty, plus some in order to top it up in order to move on to the next stage, which is why we don't want you jumping to stage 2 way too early. Instead, if you can stay at stage 1 as long as you can, you're going to start building that kitty up because otherwise what you're doing is effectively you're just burning and then replenishing and burning and replenishing. So we want to make sure that you don't get there. Now, once you're in step 2, okay, at this point, you have left your day job. You are now a full-time property developer, but you haven't yet, I guess, got to the point of financial freedom, but you are financially independent. So you're able to now move from part-time developer to full-time developer, but you're not yet, I guess, in a position to really have the life of luxury that everyone's selling you on these get-rich-quick schemes, okay? So instead, what we're going to be doing in this phase in stage 3 is we're going to be starting to build our capital base. So every time we burn down that capital base, we need to replenish it and top it up significantly by being able to run multiple projects at a time until we get to the point where we can actually convert that capital base into some form of residual income type property. And then if we collect enough of those residual income, so that is stage 4, is to actually start collecting those residual income properties. And then if we can collect enough of those residual income properties, then it should be able to, I guess, fund those expenses that we're talking about. And you then stage 5 is the actual financial freedom. Now, that sounds really easy in principle, but it takes quite a bit to actually go through the motions in order to get there. So what we're going to do is we're going to break down the steps into super granular detail to try and help you to actually understand what it is that you need to do, okay? So the first things first, okay? Like any GPS, you need to know where am I starting and where am I going? Okay, so what we want to do is we want to start to break that down for you. And the first thing that we're going to do is we're going to start to look at our assets and liabilities and our budgets, and we're going to start to assess what it's actually costing us to live right here, right now. Okay, so that is how much fuel in the car, how much food on the table, what's it cost to send the kids to school, what's it cost to pay my mortgage, have I got any investment properties? Are those investment properties positively geared or negatively geared? We're going to start to assess all of that in one giant thing, and we're going to give you a chance later on to actually download my financial position template where you can actually do this for yourself. Okay, so if you wait till the very end of this presentation, I'll give you a link. You'll be able to actually download that yourself, and you'll be able to work out what is your current financial position. Okay, now once you know what your financial position is, there's a couple of elements here. There is what's it actually cost you to live? Okay, that's really, really important. And then what are the other expenses that we have taken on over and above that that may or may not be helping us towards our goal? So, for example, if you have an investment property and it's negatively geared, it's actually adding a burden to your cash flow position. So because it's negatively geared, you need to earn more positive income in order to keep that asset. Okay. Or if it's positively geared, then it's actually helping you towards your goal. So you want to actually firstly understand what are my living expenses, and then secondly, assess each particular property to see whether or not it's actually performing as intended. Now, there are really only 4 reasons why you purchase a property. So I'm going to break that down. So firstly is capital growth. Second one is cash flow. Third one is manufactured profit, which, by the way, is property development. And the fourth one is lifestyle. So if you have any properties in your portfolio at all, you would likely, if you invested intelligently, would have had one of the first three elements to there. So that'd be uh, capital gains, cash flow, or manufactured profit. You would have purchased it with a specific intent in mind. Now, it's amazing how many times people don't have that specific intent in mind. They just buy a property hoping that it's going to do something for them. Now, when you know what that positive intent is, you should, on a regular basis, go and reassess those properties to see whether or not they're performing as intended. Now, if you intended this to be a long-term capital gain property and it's doing its thing and it's working better than the Australian average on capital growth, then that's a fantastic thing. You now know that that's building your net wealth. It's not helping your cash flow necessarily, but it's building your net wealth to actually get you to where you want to be. Now, cash flow properties are different. Cash flow properties are, I guess, able to pay you and able to subsidize those living expenses that we're actually talking about. So if we've got enough passive cash flow properties, that can actually get to be financially free. And that's what we're going to try and get to today, is to how do you actually start to manufacture these things yourself. Now, number three is manufactured growth, and that's what we're going to do. We're going to be doing property development to manufacture the investment property that is positively geared. Now, that sounds really magical and mystical, but it's a pretty simple thing to do, and I'll give you my little magic formula on how to do that a little bit later. So effectively, what we're going to do, we're going to crunch all that down using that financial position template, and we're actually going to understand every single asset, every single liability. We're going to do a critical analysis of those and go, well, why are we spending that money? Is it actually serving our purpose? Sometimes we've got some gym memberships, or we've got some streaming services or things like that that we're just not using. We're spending money unnecessarily. We can actually trim the fat on that nice and easily and kind of make that nice and simple. Now, the irony is that when you start to look at your assets and liabilities and your budgets and that sort of thing, the irony is that the lower the income you have, the more frugal you tend to live, which means that your living expenses are much smaller, which means that it's much easier to generate that amount of passive income in order to become financially free. If, on the other hand, you have a very lavish lifestyle, you might be a doctor, a lawyer, something like that, where you've got, I guess, a very good cash flow from your job, then we tend to buy big houses with big loans and nice cars with big loans. Our credit cards tends to stack up. Now the actual debts that we need to do in order to fund our life are much bigger. So the amount of positive cash flow property that we need is a lot harder to actually get there. So we're going to look at all of those, and we're going to actually understand what those living expenses are. And as I said before, wait to the very end. I'll give you a link, and you can actually download your own financial position template. Okay. So as we start to look at that, we're going to look at things like, well, the debts that we actually have, are they tax deductible debts? Are they non-tax deductible debts? Are they actually helping us? Are they hindering us? So really critically analysis of where we're actually starting, because that's going to set us up for, well, if I know where I'm starting, then we should then start to map, well, where do I want to go? Now, where do we want to go is, well, we need to work out how many positively geared properties that we want to own in order to pay those expenses. So it's a fairly simple formula that goes into that. Now, when we start to look at it, the number of properties that we need to own, if we have it in a capital city, if it's owned outright, okay, and I'm really clear here, if it's owned outright, typically you're going to generate net about 25K per year per property owned outright. So we're going to touch on how we're actually going to get there in a sec. But I guess that's what I want you to keep in mind. So if you currently have a burn rate, I know I touched on it before, of 80 odd K, that is the typical Australian wage, by the way. So if you've got the typical Australian wage and you're spending all of that on your living expenses, you're not moving forward, you're not moving backwards, then that's going to be typically where most people are going to land. Some of us live a better lifestyle, but typically if you had that 80 odd K, you need somewhere between 3 and 4 properties owned outright, which is not a big deal in order to get there, okay? Some of us, though, as I said, have much higher living expenses, so we might need 5, maybe 6 properties in order to get there. Some may even need more, but you need to actually understand where that sits, okay? And I'm going to touch on a little bit later how we start to manufacture those using that third strategy, which is the manufactured growth approach. Now, for anyone looking to do investments in properties, there's really three ways that you can actually generate wealth through property. Okay, so there's passive investment. So a passive investment is typically your buy and hold investment. So this is what I did for the first 20 years of my property career. Bought my first house at 18, my first investment property at 21, and I did 20 odd years of buy and hold. Now, don't get me wrong, folks. It works. It works very, very well. It just works very, very slowly, and you're at the mercy of the market, and you're also at the mercy of your borrowing capacity in order to actually start to accelerate. So if you're trying to do it passively, it's going to take you time to get there. And typically, those passive investments typically tend to be more of that first approach, which is the capital gain. So it grows your net wealth, but not your cash flow. So you might be asset rich, but cash flow poor. Now, what we really want is we want to be time rich. And the only way to be time rich is to actually have the passive cash flow to mean we don't have to work. So passive investment, to get that positive cash flow, can be very tricky in order to get there. So then the next way to invest in property is what they call semi-passive. So that is you don't necessarily become a developer yourself, but you might actually have a property that has development potential, and you might partner with a developer, and the two of you might do a joint venture where you own the land and the developer does the work. Or alternatively, you might have a whole bunch of cash or equity in other properties that may or may not be developable, but the equity might be something that's attractive to a developer. And again, you'll join forces with that developer. So you use your passive cash and they use their active skills and they put that together so you can benefit from it that way. Okay. Or lastly, which is the way that we're trying to, encourage you to start to look at with a little bit more, rigor, is an active developer. So an active developer is a property developer who actually uses their skills, their skills and their effort, I should say, to force value onto the property. Okay. Now that means that you have to do a lot of work, a lot of education, a lot of skill building to actually know how to force that value on. So that's how we're going to be looking at this, is using that active approach in trying to push us forward. Now, once we have this active approach, there's three strategies to start to consider. Now, if you've been listening to me for quite some time, you hear me rabbit on about, we want you to lock in one strategy, right? But I'm actually telling you there are three. But I want you to very carefully listen to my words, okay? One of them is your development strategy. That is, what are the skills that you're actually going to learn? That is, do I want to be a subdivider? Do I want to do someone who's doing townhouses? Do I want to do units? That sort of thing. So the development strategy is the skills that you actually use. Then you've got an acquisition strategy. So an acquisition strategy is more tactical. That is, when I go into the deal right here, right now, how much money have I got in my pocket? How much money have I got access to from investors and things like that? And when I talk to the vendor who has tried to sell their property, what terms is that vendor willing to work with me on? And what we try to do is we try to marry those two together. So we need to understand their issues, their challenge, and we need to understand our starting position, and we will tactically change how that acquisition strategy actually works. So sometimes it might be an outright purchase. Sometimes it might be delayed settlement with early access. Sometimes it might be a joint venture with the landowner. Sometimes it might be an option contract, and many, many other ways to actually put that together. So that acquisition strategy is tactical. So let's just imagine you've got a whole bunch of cash the first time around. You go into the first deal, you spend all that cash. Now you've got no cash left. So you go into the next deal, the exact same development strategy, but when you go to acquire it, you look in your cash reserves and you've got none left. So you have to tactically say, well, how do I stitch that deal together? And that's why it's a tactical approach, is because it's looking at that position at that point in the journey to go, how do I marry my position with the needs of the vendor actually selling the property? And then the last strategy you want to start to think about is your exit strategy. That is how and when I actually cash in on the profits in the deal. So am I going to sell everything? Am I going to sell some things? Am I going to keep some things? Am I going to sell it as development approved? Am I going to sell it as land? I'm going to sell it as a finished product. Am I going to only construct half of it? Am I going to construct all of it? Those exit strategies, we want to do that strategically. So we're going into the deal and we know strategically how we want to get out of the deal before we actually sign the contract. Really important that you actually know that up front, because that's going to change a whole bunch of things, like the entity that you actually go into, the structuring that you put together, how you actually put your loans, all those sorts of things that are actually going to go into that. So those three elements you're going to start to consider every single time you go into a deal. So what rules am I learning? How am I acquiring the property? And how am I exiting it? You want to think of all three of those every single time you actually go in. Now, the things with the development strategy itself, okay? Now, there are many, many, many development strategies out there. There'd be a good 50 to 60 development strategies that actually sit out there. Every single one of them works, folks. Every single one of them makes money. So I'm not trying to, in any way, shape, or form, discourage any of the other strategies. However, there are only two development streams, only two that are scalable. Okay. And this is really important to understand this concept. By scalable, what I mean here is that you can start small, learn the skills with a small amount of investment, learn the very basic skills to get into that small deal. When you cash in, you can reload and do a very slightly bigger version of that same deal, right? And then when you, again, learn some skills in that particular one, then you do a very slightly bigger one to there. So there's only two streams that actually allow you to do that. So the first one is a land subdivision approach. So with land subdivisions, you can start with splitters, you can do boundary realignments, you can do small lot, side-by-side developments, battle axe hatches, that sort of thing. Then you can start to do maybe a 4-lot subdivision, 6-lot subdivision, up to 20 lots, 100 lots, building roads all the way through to full master plan communities. So you can start itty bitty small and start to scale that thing. Okay. The next stream is what we call multi-res. Okay. Now, multi-res has two different ways of scaling. So townhouses and units. Okay. Now, they largely pretty much fit the same rules with regards to how you actually assess the site and the densities that you actually get out of them, hence why I'm considering them within the one stream. Now, for townhouses, you can start with dual occupancies. You could do a 3-pack, 4-pack, 6-pack, 30 townhouses and scale, right? With units, you can start to, do ground floor units, 2 stories, 4 stories, 6 stories, and keep on going up until you get to 100-story type apartments. So the difference is, with townhouses, you scale out. With units, you scale up, okay? With land subdivisions, you also scale out. So what we're trying to do is we're trying to give you a set of rules that you're going to choose, that you can start small, build your skills, and start to scale. That's super important that you can actually do that. Now, where I see a lot of people go terribly wrong here is they think that they're going to start with one strategy and then they transition across to the other one, and they don't actually get to leverage the skills that they learn along the way from the first part of the strategy process that they did. So let me give you an example. Okay, so this is a little bit of a metaphorical example, but hopefully what it will do is give you some insights into what I'm thinking here. So for a land subdivision, I want you to imagine that this arm is doing land subdivisions and this arm is doing townhouses, okay? So if I start on a land subdivision approach, I'm going to pick up a 5-kilo weight and I'm going to exercise this arm. I'm going to learn pretty good. I'm going to put that 5-kilo weight down, and now I'm going to pick up a 10-kilo weight and I'm going to do a 4-lot subdivision, and I'm going to start to weigh this. Arm's getting really buff. This arm's done absolutely nothing at all. I'm going to put it down. I'm going to pick up, I'm going to maybe do a 6-pack and pick up a 20-kilo set of weights. And I'm going to start to pump that arm really good. This arm's looking really buff. It's starting to look like Arnie. This arm's done absolutely nothing. Now, if I then jump across into the townhouses and try to pick up and do a 6-pack of townhouses at the same time, this arm's really weak. It hasn't built any skills. It's not going to be very good at that. And you run the risk of actually hurting yourself, okay? So this is what I'm trying to say to you is pick one stream, doesn't matter which one, and get really, really good. Doesn't really matter if you've got one bulging bicep and the other one that's really scrawny, so long as you're actually getting to where you're actually going. So pick that development strategy based on a whole set of rules and criteria that are going to sit around your current position and where you think you want to go long term. So there's a couple of questions that you want to start to be asking yourself as to which development strategy will work for you. Now, I can't tell you what's going to work for you. I get asked that all the time. How do I tell what's best for me? What I can give you is the questions that you need to start to ask yourself to go, which one could potentially work for me? So the first one would be, well, how much cash have I actually got handy? So if I've got not much cash at all, then I guess land subdivisions is a little bit less cash intensive in the early phases. Townhouses or units are a little bit more cash intensive. So there's a pro in one and a con in the other. So you want to go, okay, well, that's probably not I guess the one and only deciding factor. The next one would be, well, even if you do have some cash, or even if you have the ability to get cash from somebody else, then the next question would be, well, how long can you wait for payday? So a typical land subdivision might only take 9 months in order to get a payday, whereas a typical townhouse project might take 18 to 24 months, so a lot longer for a payday period. So if you can't wait for payday, then townhouses starts to become a little bit less attractive. Okay. Next one would be, what are your skill sets? As in, have you put the extra effort in that it actually takes in order to start to do a townhouse project? Because there is a little bit more complexity. You're not just doing, I guess, the civil services that are sitting under the ground, but instead now you're actually doing construction and house designs and renders and marketing and all sorts of things like that. So there's a lot more complexity that goes into a townhouse or an apartment type process. So have you got the time, the energy, and the effort that you're going to put in to actually learn those extra skills? So that makes townhouses a little bit more, I guess, effort driven to actually get there. Lastly, what is your risk profile? So if your risk profile says, hey, I'm relatively slow and relatively timid in my risk profile, then you're probably going to be injecting a lot more cash into a townhouse type project. And so there's, I guess, some negatives towards there. But on the flip side, there's a couple of other things. So because townhouses actually cost a little bit more to run, and if you have the same percentage profit on cost for your project, the profit on cost is on a much higher cost. Therefore, the profit that you make from a pure cash perspective is going to be a lot bigger, typically in a townhouse type approach. So in that townhouse type approach, you might, for example, start with a dual occupancy. You might do a 4-pack, 6-pack, and then start to grow. Because you're doing the actual construction element, the percentage profit on cost is that bigger number. So when you finally do get paid, even though it takes longer, it's like drinking from a fire hose. Okay, so there's advantages to the multi-res side of things. It takes longer, but you earn more physical cash at the end of it. Given the same deal complexity for that stage in your journey. Now, one of the negatives for townhouses or apartments is that you either construct all of them or none of them once you've got an approval. If you're trying to do a 6-pack, for example, you can't build 2 townhouses. Council will tend to say, no, you need to build all 6. That's what you got approved, build all 6. But if you do land subdivisions, you could sell everything as land. You could sell some of it as land and some of it as house and land. And you could even go and construct one of them as an actual finished product. So you get the flexibility of what your exit strategies are. And so hence why I was saying before about thinking about your exit strategies, knowing how much cash you've actually got handy. They're some of the things you want to start to think about actually when you start to go into the process. So when you weigh all of that up, the actual running costs for running a land subdivision, probably somewhere between 80 and 150K, depending upon the deal complexity and the deal size. Whereas when you're looking at townhouses, you're probably looking at 100K up to 180 odd K for your first kind of deals from a liquid cash perspective. So those sorts of things can weigh into, well, I can't even get into one of these right at the start. So therefore, that's going to lean you one way or the other. Or you might have all of those resources and you might be able to actually take that on and you want to have a really big crack. Either way, what I would say to you is start with the end in mind, okay? Where do I want to be in 5 years' time? What is the deal that I want to finish on? Do I want to be doing townhouses? Do I want to be doing units, apartments, that sort of thing? Or do I want to be doing larger lot land releases? If I know where I want to be in 5 years' time, what I can then do is to say, well, what is the step that I can do right here, right now, that takes me towards that goal? There is no point living in Sydney wanting to travel to Melbourne and start by driving to Brisbane. Okay. What you want to know is exactly, well, I know where my starting position is, I know where my ending position is. I want to start to do the things that actually take me there in the shortest possible path. And that's where I see a lot of people go wrong is they don't know where they're starting, they don't know where they're ending. And so when they start to take the steps, they're not actually taking them in the direction that they want to go. So we want you to very clearly understand what that is. You want to understand where that end goal is, and then start to map that out. Now, part of that is, well, if I'm going to know what it is from a project perspective, then we want to go looking at our budgets and our assets and liabilities, our budget. We know what our burn rate is. That burn rate is then going to be how many positively geared properties do I actually want to own outright in order to get there, doing that strategy. Okay, now when we do that, we start to go, okay, well, if, for example, I used that example of 80 odd K before, that's kind of 3 and a bit properties. So let's just say 4, okay, because you kind of need to round up. You can't round down. You can't own half a property easily from a cash flow perspective. Well, you can, but there's going to be some debt. So let's just say 4 properties owned outright. Well, we want to get to a point where we say, well, how do we actually own those outright? Well, there's a magic formula that actually goes into this. Now, you will all know this particular answer, so I'm going to ask the question to you in a rhetorical way. What is the typical profit on cost that you hear out in the market that any developer needs to earn in order to be funded by the bank? Okay. Now, almost unanimously, if I stuck my hand up to my ear and I said, can you all unanimously tell me the answer? You almost always say 20% profit on cost, okay? Every now and then I hear somebody say 25%. Every now and then I hear somebody say 30%. But 20% is the stereotypical number that everyone is looking to earn. So if you are earning a 20% profit on cost, there's a magic number of 6, okay? And the magic number of 6. If I do a project that has 6 in size and I have a 20% profit on cost, then what I know is if I sell 5, that will actually pay back the costs. Then the 6th one is owned free and clear. Okay, now that's really important to actually understand. It's actually 6 and a tiny little bit because when you start to look at it as a profit on cost, there's actually a small little surplus that actually sits there on that 6th one. And so that is what we're trying to do is we're trying to collect those properties by doing projects that are 6 or more in size so we can actually keep one. So in our instance before, we were talking about trying to earn that 80K. We wanted to round up to 4. That's 4 projects that we want to earn that are 6 or more. So then knowing that that's the case, we've chosen our development strategy. Now we know what our finishing deal size is, 6 or more of that particular strategy. Now we've got to say to ourselves, okay, that's where we want to end, but how do we start to unravel this and say, how do I get the skills in order to do that 6? Okay, so for example, I'm just going to use a land subdivision because it's a much easier one to actually articulate. Okay, so for example, if I wanted to do a land subdivision, if I did 6 blocks of land, okay, if I sold 5, it would pay down the debt and I would own the 6th one free. The problem there is that land doesn't generate rent. So yes, I own the land free and clear, but at the moment, that's an asset, but it's not a cash flow generating asset. So we need to start to think a little bit differently. What we need to say is, well, if I'm going to be doing land, I actually need to be constructing the house at the end of that. So I might do 6 blocks of land where I build 6 houses. I'm going to sell 5, keep 1. So that's one approach with a land subdivision. There's a second approach with a land subdivision. Second approach would be, well, what if I actually did a bigger deal? What if I did 12 blocks of land? Okay. Now, if I keep that 20% profit on cost, I know that if I sell 10 of those, that will then pay down the debt, and that will give me 2 blocks of land owned free and clear. Again, that doesn't give me any rent generated on that. Now I sell the 11th block of land, And that funds, I roll those cash over, and that funds the construction of a house on the finished one. So then we've got two different ways of actually getting out. So I could do 6 house and land, where I build all 6 and sell them as completed product, or I could do 12 as just vacant land, sell down 11 of those, and that would then allow me to fund the construction of a final one. So either way, when you know what that final project is, now what we can start to do is start to work backwards and say, well, now that I know what that final project is, and I know that I'm going to need 4 of those in this particular instance, how do I start to get the skills in order to do that? Okay, so I'm going to use the example of the 6 where I'm building 6 homes. Okay, so there's a couple of elements that we're going to break this down into. So, firstly, just from a pure skills perspective, I want you to suspend all belief at the moment with regards to how do I fund it. Okay, but just from a pure skills perspective, we've got a couple of things that we want to learn in order to get there to actually know how to do that. So, firstly, do we know how to build 6 blocks of land? And then, secondly, do we know how to build 6 houses? So, let's break those down into 2 separate stages. Okay, so from a block of land perspective, well, I might do a 1 into 2 subdivision, then I might do a 1 into 4 subdivision, then I might do a 1 into 6 subdivision. So each step of the way, I'm building on the skills from the previous project and then stepping up. So now I've gone 1, 2, 3 projects in order to get my skills in order to get there. So that's now 6 blocks of land, but I haven't yet learned how to do 6 homes. So I might then say, okay, well, I can't do 6 homes first go because I haven't got my cash reserves and I haven't got the skills in order to do that. So what if I said, oh, on the first one of those projects, I might do 6 blocks of land and build 2 homes. And the next project I might do build 4 homes, and the project after that I'll do 6 homes. So finally, I kind of step that up. So when I actually map that out, that particular development journey might be I'll do a 1 into 2 subdivision, sell everything as land. I do a 1 into 4 subdivision, sell everything as land. I do a 1 into 6 subdivision, sell everything as land. 1 into 6, then I'm going to build 2 homes. 1 into 6, build 4 homes. And finally, on that 6th project, I can now do 1 into 6 and build 6 homes, sell 5, keep 1. So we've built a development journey that actually kind of gets us along the way in order to get there. So we want to be very clear. So this we call within our property development formula program, we call this the 5-year property action plan. So we're kind of mapping out what is that deal trajectory. Now you can do the same sort of approach where you're doing this for townhouses. You can do the same approach where you're doing this for units. But what we want to do is kind of break down what are the skills in order to do that. And if you start with the end in mind and start to work backwards, you can actually say, well, what is the deal size that I need to work on right here, right now? Okay. That then starts to inform everything that we do moving forward. So if I know what my first deal size is, then what I want to do is go, where does that start to work? Okay. So that 5-year property action plan is what do I need to do? And then the first deal size, we start to go, where do we want to do that? So we're going to start to look for evidence of success that says, where are we seeing lots of opportunities that fit that first deal size? Now, in that example, I used a 1 into 2 subdivision selling as land. So where are there lots of 1 into 2 subdivision opportunities? Then we're going to look for all of the evidence of success that other people have done exactly what we want to do in that area. We want to reverse engineer their particular deals. And by reverse engineering their deals, we're going to prove whether they were actually profitable or not on average across the entire suburb. Okay. Now, that process takes a little while to actually do, to try and do the elements of the research. But if we can find areas where there's lots of opportunity and we've proven other people are actually making money in that particular area, then all we really have to do is just manage and keep an eye on the market and make sure that the supply and demand is not oversaturated and that we are meeting the demand that's actually there. We're not creating too much extra stock. But if we keep an eye on that, then chances are if the person before us was profitable, chances are we're going to be profitable. So that's going to understand where that's going to work. Now, where we know where it's going to work, that's going to start to tell us, well, how much is that going to cost in order to do that? Now, it might be a very different purchase price in one particular area than it is for another area. So where we see areas where there's lots of opportunities and it's profitable, that's going to start to tell us, well, what's our total development cost? Now, remember, we looked at our assets and liabilities, we understood our starting position. Now we can actually see the gap between what we've got and what we need to do in order to do that particular deal. That gap is then going to start to determine that tactical element that we were talking about before with regards to our acquisition model. So, how do we acquire that property given that there's a gap in those resources? And where those resources are actually going to have gaps, you're going to have gap in potentially the cash flow in order to run the deal. You're going to have a gap in potentially the equity in order to secure the loan in the first place, or you might have a shortfall in the serviceability in order to fund the deal. So when you actually understand that, then you want to start to understand the needs of the vendor and go, well, if they're not in a hurry, then maybe I don't need to purchase it today. Maybe I could purchase it in 12 months' time and pay a little bit extra for it. But in the meantime, they give me access to the property. Now, if that's the case, well, if I'm purchasing in 12 months' time, do I need a deposit? Probably not. Do I need the serviceability? Probably not. So it might be that you can actually run the deal, sell the finished product, and then get paid from the revenue of the selling of the finished product in order to pay for the first property. So you can start to do really creative solutions like that. But only if you actually understand, firstly, what is able to be done. That is your development strategy. What your starting position is, what the deal size needs, what the vendor needs, and then you start to stitch all of that together. So you've got to kind of put it together in little building blocks, okay? So what we do there is we start to break those elements out and we start to build, I guess, that 5-year plan that builds our little deal trajectory, deal sizes, and then that we start to map that out with what we call a SMART goal, okay? So SMART is specific, measurable, achievable, realistic, and time bound. So for each one of those deal sizes, we want to start to map out exactly what it is. So for example, I don't do some loose goal that says I want to be a successful property developer. No, why don't I get really specific, measurable, achievable, relevant, and time bound? So I want to do small scale land subdivisions within a specific council. Okay, it's going to be measurable. I want to make a minimum of 100K I guess, profit out of this particular deal. Okay. I want to make sure that it's achievable. Yes, it's actually within my skill set and I've actually started to learn the skills that I actually need to do it. Is it relevant? Absolutely, it's relevant because it's going to get me towards my next goal and my next deal size because it's going to teach me the skills in order to do that. And time bound, well, I want to actually give myself a deadline to actually try and get this thing that's realistic. So instead of going, hey, I just want to be a successful property developer, I'm going to start to say something like, I'm going to make 100K cash by doing a 1 into 2 subdivision within Brisbane City Council, as an example, before the 31st of December 2022 through small-scale land subdivisions inside that council. Okay, so you're getting very, very specific, and each one of those steps on that 5-year plan, you're going to be that specific so you know exactly what you're looking for each and every time. So when you start to do that, you're going to get to the point where your debt, every time you go into a project, your debt is going to increase like that. And then when it shrinks down like a balloon, I want you to think of your debt like a balloon. So you're going to expand the balloon. And then when it shrinks down, it never goes back to its original size. And what's left over is the profit, okay? Now, we will reload that profit the first couple of deals, and then we're going to blow up the balloon again, do a slightly bigger deal, and then we're going to shrink it down, and it never again goes back to the original size. So we have a little bit more profit left over. Then we're going to do that again until we shrink it down until the size of what's left over happens to be that property that we're going to own outright, right? Remember I said that magic number of 6? That's what we want to try and get to. So if we do that, here's the fun part that actually comes out of that. If we're going to keep it, then we haven't actually technically realized the profit. We haven't sold it and actually realized the profit, which means that the profit is stuck inside the property. And at some point in the future, when we sell it and we realize the profit, we'll pay tax at that point in time, somewhere down the track. Now, that's going to be way down the track and deferred because why would we ever want to sell it if this thing is owned outright and giving us positive cash flow, okay? So if we keep the property, then we actually get to keep 100% of the profits. in the deal and until we end up selling the property at some point, which might be 20, 30, 40 years down the track, might be when we die, when we hand it off to our kids, whatever it is. So 100% of the profit stays in the deal, 100% positive cash flow through our rental income. And the asset now has actually become a manufactured wholesale investment. So we've actually gone from manufactured profit into passive investment, and we're going to keep that passive investment for the long haul. And like most other passive investments, every 7 to 10 years, typically the net wealth is going to grow. So it's going to double in value property, if probably I should say, if we've got that in the right kind of area. The rent's going to go up over time. So that starting position where we're getting 25 odd K as a starting position, that's great, but it's going to slowly grow over time. So this is something that's going to be the gift that keeps on giving. This is what we want to actually get to, folks, is being able to do this and keep that stuff. So ultimately, that's our goal. We want to get there. But in the short term, we have to do, I guess, the cash cow deals where we're doing those smaller deals where we sell up, realize all of the cash, because we're in the early days, whilst profit is important, in the early days, what we're really trying to do is build our skills, and we're trying to build that equity base. The equity base, you see, is actually something that's going to be really important when we start to do the larger deals. Because when you start to do larger deals, especially if you jumped out of your working day job a little bit early, then at that point, you're not going to be able to service loans anymore using traditional residential lending. You're going to start to be using what is called commercial lending. So commercial lending starts to not look at your income generating capacity, but instead starts to look at the profit of the deal. Now, when we understand the profit of the deal, that the lenders will typically say, okay, if the deal is going to make, and we touched on before, 20% profit on cost, then almost guaranteed you're actually going to get funding for that if you've got the equity in there. So we need to start to build that equity base. We need to start to build a little bit of liquid cash. So those early projects are really about building skills and building the nest egg, right? That nest egg is something that we don't want to tap into too early. Because if we tap into that nest egg in the early days, remember our burn rate we touched on before, that burn rate with regards to, hey, I've got to pay my bills and that sort of thing. If you leave work too early and you've built that nest egg, you start to erode the nest egg. So whilst it's really tempting to jump out early, sometimes it's actually not in our best interest. So it's better off to keep our day job and earn an income, keep our property development as our side hustle on the side, earn another income, top up that nest egg really, really well. In the early days, might be for one project, two projects, maybe even three projects to kind of build the skills and that sort of thing before we actually start to jump early, okay? So the key thing for you is to try and work out, well, what is the number of properties that I need to earn? So that's, I guess, number one for you by doing that assets and liabilities and your budget. Okay, then divide that by 25K. That typically will tell you, if you're doing that in a capital city, how many properties you need to earn. Then break that down to say, well, how are we going to, if I'm going to do a project that big in order to do that, how do I break that down into much smaller projects in order to get there? Okay, so that's kind of the mechanism that we're going to do in order to get there. The elements that you're going to have and struggle along the way, okay, at different stages is depending upon when you leave your day job, you're going to have some financial challenges, okay? So if you stay in your day job, as I touched on before, you've now got two lots of revenue that you're going to deal with, and you're starting to build a nest egg. That starts to make you really attractive in the residential lending space, okay? However, I guess at some point, you're going to want to transition to commercial development, because residential lending is not something that is really intended to work for property development. And because of that, you get to a point where the deal size gets larger than typically 3 dwellings or 3 blocks of land. And the residential lenders go, hang on, what you're doing is now more in the commercial space, and they'll kick you over to the commercial guys. So you want to understand that. You want to start to plan for that. And so building that nest egg, that equity base, is super important in that process in the early days. Don't be tempted to jump way too early, okay? So you want to start to think about the equity base, not just for the point of acquisition, but you actually want to think about for the point of construction. So when you actually go to construct, there's three phases when it comes to lending. There's the acquisition, there's the construction, and then there's the refinance of anything that you have at the tail end. So you want to start to think of the peak debt being in that construction phase to say, well, if I know what my peak debt is, because I know what my deal size is going to be and I know where that's going to happen, so I know typically what those costs are going to be involved, how much equity would I need to be in there? And typically, you're going to want about 30% of the total development cost as equity in the deal. Okay, so you need to start to build yourself a nest egg that actually starts to do that. If you don't do that, okay, if you don't have that nest egg, some of the challenges you're going to have to find is, well, how do I actually get investors to either top up my equity? Maybe they might come as joint venture money partners. Make sure that we're not running out of equity. Make sure we're not actually running out of cash flow. So you might need to start to partner up with people. Now, partnering up with people is not a bad thing. It's actually a good thing because together you're going to be able to achieve more than you would on any individual basis. As a matter of fact, almost guaranteed, most people are going to need some form of investor or joint venture partner along the way, because even if they've got cash for deal one, I touched on it before, you go and you spend all your cash on deal one, deal number two comes along, all your cash is spent. So you're going to almost certainly going to need an investor or a JV partner for deal number two. So why not accept that that's likely to be the outcome? Work on the idea that, hey, I'm going to try and get that investment partner in for deal number one. Yes, I might share some of the profits, but it allows me to, I guess, be flexible and nimble, and keep that cash in my pocket. And that means that the next deal I actually come across my desk, I can be flexible in how I actually start to acquire that. So we want to think about those things as we go. We also want to think about whether we want to jump out of our day job early. Remember I said, I guess stage one's learning the skills. Stage two is swapping your day job for your property development job. Now, if you go too early, right? If you go too early, you're going to make it much harder for funding your deals in the early stages. You're going to make it much riskier as your nest egg isn't going to be big enough and it might not be able to sustain your burn rate. And you're more likely to actually need joint venture partners and investors, okay, if you go too early. So my guidance is at least two projects and preferably three, I guess. So at least two that you've been paid on, and then maybe get into the third one before I even think about, do I jump early? Okay. The other approach would be delayed gratification. Do I stay in my day job for as long as humanly possible? Much easier to fund deals because you've got double the income, double the serviceability. You've got no burn rate on that nest egg. Okay, so you're able to leverage all of that all the time. You're able to have I guess, because you've delayed this, you're going to have a demonstrated track record. By the time you actually get there, you have multiple projects underway that you've been able to afford to run yourself. And you'll have a very sizable nest egg in order to do that. The only negative with the delayed gratification side of things is you have to keep doing your day job, which means you have less hours in the day before you actually quit. So you may not be able to get as many projects underway if you do that delayed gratification approach. That said, we see typically that the effort to run a project versus the duration, what you tend to find with effort is that there's a small amount of work, and then you give that work over to your town planner or your architect or your civil engineer, and they take a couple of weeks to try and do it. So the effort that you do might only be a couple of hours, the duration might be a couple of weeks. And so you can effectively run multiple projects at a time. Typically, we find people doing 2 or 3 projects without too much drama at the same time while they still have a day job. The hardest part about that is not running the project. The hardest part is actually finding the deal, having a process that you can actually do in order to get there, okay? So make sure that you do that every single time. Now, as you start to go through each deal, remember we've built a deal trajectory now. We know what our deal sizes are. At the start of each deal, as you start to go in, you want to be very, very clear at the end. So in actually going into that deal, what is the purpose that that particular deal is serving for you? Okay. So clearly learning some skills. Okay. But you want to start to go, well, is this the deal that's just going to generate me some chunk cash to go into my nest egg? Or is this the deal where I start to transition and actually start to keep one of those properties as positive cash flow? Or do I keep it with a lot of residual debt where the cash flow is just washing its face, and it ends up being a very large burden around my neck because I've got this debt and it's only just being able to wash its own face with the amount of rent it generates. So let me reassure you, that's a bad thing. So please don't do that. So you want to either cash in, get the cash, roll it over into the next project, or get to the point where you own enough of the asset that it is well and truly positively geared, very, very low residual debt as much as humanly possible. So you want to start before going in, you need to know, will this deal size get me that outcome? Is it going to give me cash? Is it going to give me the cash flow? Okay. When you start to do that, you're clearly going to understand, well, the deal complexity, because is this deal number 1, 2, 3, or 4 in the project? You're going to know how complex that is. You'll have built your skills as you went along the way. You'll also know as you go in what your intended exit strategy is, because it's going to set you up for the deal after that. So if you know what that exit strategy is, that's going to help you to understand that, are you taking that as a chunk cash, or are you taking that as a cash cow type deal? So you want to know, are we going to sell and reload everything? Are we going to sell some of it, all of it, none of it, etc.? Okay, super, super important that you actually do that. Where it gets really tricky is if you cash in a little bit too. Sorry, if you don't cash in, and you try to keep an asset and there's too much residual debt, starts to become an anchor around your neck, starts to become a little bit of burden. You want to try and really, really avoid that. Okay. Now, some common mistakes that I see when people are building that roadmap of deals out, is they do one of two things. They go, hey, it's actually hard work to learn how to do the first project size. So let's just say that you're doing a duplex. Okay, so hey, that's hard to do a duplex. I might just repeat doing that duplex. I might do that a couple of times, and so that what they do is they do a duplex and then another duplex and then another duplex and another duplex, and effectively what they've done is they've just bought themselves a job because they're earning just enough to kind of repay that burn rate. They're not really topping up much at all, and they go back and they do the same job and they do the same job. They don't step up. Okay, so by stepping up in deal size, they're actually going to progress their journey forward. That's one common mistake that I see. The other one is that they go too fast, too early. Okay, so they try to step up too much, and they go, "Well, I'm going to go straight to a 6-pack without doing a duplex. I'm not going to do a quadplex. I'm going to go straight to a 6-pack. I might even go 10 townhouse type project first go." They go too big, too early, too hard, and they blow themselves up. That's the other common problem we see. What you really want to be is, the turtle and the hare. You want to be the turtle, slow and steady. Okay, very deliberate, very methodical, small, medium, large. Repeat the large. Start keeping our projects as we go. Now, whenever we're doing some of those assessments for our next deal, be very, very careful. Don't buy yourself a job. That's super important. Always look for an opportunity to start to scale to the next level. Too many people fall into that trap, as I said, of doing those small projects over and over and over. Always look for opportunity to keep your profits where it makes sense. Okay, much, much easier to do these on your larger deals where you've got a 20% profit on cost. The magic number is 6. If you have a 25% profit on cost, the magic number is 5. If you've got a 30% profit on cost, the magic number is 4. So the better the deal, the less actual assets you need in order to keep one as profit. So know that that's the case. Once you've got momentum early, I guess keep making sure that as you exit that deal, it's actually setting you up for the deal next. Okay, if you leave your equity trapped in there, and you can't actually get it out, it actually starts to become a little bit of a burden for you. So make sure you don't do that. If you choose to keep your profits, then ensure you can pull that capital back out. That's the super important thing there. And just because you can doesn't mean that you should. Okay, I can't stress that enough. There are many, many projects that are developable but not profitable. As a matter of fact, 90% of all development properties are developable, are not profitable. So you want to make sure that you're super much doing your homework in getting yourself ready, and that's going to help you massively by mapping that out and getting super clear on what that is. You're going to be able to tell, is this the deal that I actually want to go into? Okay, you want to make sure it matches your development strategy, it matches the deal size that you need to be at this point in the journey, and that you've got the right skills because you've built your way up there by going small, medium, large type deals before you go too early, too hard. So that's it, folks, in the how to do it. Hope that's helped massively. I did touch on before that I'm going to give you the opportunity to actually download our assets and liabilities spreadsheet. So there's a link here. So your financial position template, if you want to follow that link. So it's propdev.info/budget. If you go to that particular page, you will find, I guess, the resource to actually download. It's a spreadsheet. You can fill in your assets and liabilities, fill in your budget, that sort of thing, and you can start to work out what is your financial freedom number. Super important, folks, that you do that, knowing exactly where you are, know exactly where you want to get to. And just like a GPS, you can then start to tell whether or not you are actually on track in order to get there. Now, that said, what I'm going to do is I'm going to try and jump out to Facebook land and see whether or not there's any questions out there. So just give me half a second while I try to do that. Now, sometimes when I do that, it does give a little bit of feedback. So give me 2 secs. Okay, plenty of questions here, folks. So let me just try to read them out. So Arash says, "Hi Rob, you've mentioned in previous sessions there are different educators for different strategies in development. How do I know which one suits me best without being certain about my strategy? As all the educators will go through different strategies, cons, pros. After you've signed up with them, is too late. It might be too late to do a different educator that's possible. Could be a better choice for your strategy." So that's a very complex type question, Arash. I might try to re-paraphrase that if I can, so that everybody actually understands the question. So one of the things that I've touched on many, many times is that there are many great educators out there that teach lots of great things. Okay. The problem is if you are not clear on what your development strategy is, then you go do a course. It might be a fantastic course, but if it doesn't solve the problem that you need, it is not a fantastic course for you. And there might be two people sitting side by side inside the same room. One person, it suits perfectly where they're going, and the other person, it does not suit where they're going. One person thinks it's a great course, the next person thinks it's a terrible course. Now, the reality is that neither people are wrong. It just they didn't one didn't take the time to actually work that out. So, Arash, I think the first part is be very, very clear on what development strategy that you want to do. So there are a ton out there, as I said. So there's rooming accom, there's subdivisions, there's townhouses, there's commercial, there's industrial, there's renovations. There's lots of different ones out there. Um, I can only tell you what I teach. So what we teach is the subdivision, townhouse, and unit type approach. Both of those, as I touched on before, are scalable. So if you're wanting to go down the path of scaling, I can tell you that I am one of the educators. There are other educators out there that do that as well. I'll let you do your own reconnaissance on those guys as to whether or not they're going to be suitable for your purposes. But how we do it is we actually break that down for you and actually help you to build that plan. Now, I'm not legally a financial planner. I can't give you the plan, but I can help you with the framework so you can actually build your own plan and then start to get there. So hopefully that helps, Arash. Tim says, "I have everything paying for itself at the moment, but that's on interest only. And if I decide to get another similar positive cash flow property, I'll be maxed out on lending. When interest only goes back to higher principal and interest, it doesn't leave me anything left over to live." Okay, this question actually goes for quite a while, Tim. So I'm going to try and see if I can skim it and see what you've got. Project that 5 years down the track will be potentially paying more in loan repayments to what? Okay, so let me kind of jump to the punchline here, Tim. What you've got is that typical scenario where I touched on before, where the debt is actually the crippling element here. So, and at some point, interest rates are going to go up. They're talking about interest rates going up very, very soon. And while you're only paying interest only, and it's only just washing its face, as soon as it goes back to principal and interest, or as soon as the interest rates start to come up, it now starts to become a noose around your neck. Now, I really want you to start to think about, I guess, that concept of the balloon: expand and contract your debt, expand and contract. And unless the asset is able to 100% fully fund itself and contribute positively in a significant way towards your cash flow and that financial freedom number that you're looking for, and any original investment that you put in, you're able to pull out. If you can't do that, then the asset is probably a little bit of a burden around your neck in the early stages. It might help grow your net wealth, but it's not going to help you with your cash flow. Your cash flow is what's going to buy you your time back. So you want to be able to get that cash flow, you want to get your time back, then you can worry about your net wealth, okay? So your net wealth will take a long time to actually build, but you really want to get out as quick as humanly possible so you can get into that net wealth kind of stage. So for me, mate, I would be starting to have a look at those assets. Remember, there were four reasons why you want to buy them. So capital growth, cash flow, manufactured profit, and investment. Lifestyle, I should say. You want to start to have a look at what was the original purpose that you bought them for? Is it actually serving its purpose? Could you repurpose that money a little bit better if you had the skills in order to do this and manufacture the profit yourself? And when you know how to do that, then you might be able to make a different decision as to what you actually do with that particular asset. Hope that helps, Tim. Melinda says, great analogy. Thank you. 20%, 20%. Chris says, excellent advice as always. Thank you, mate. John says, great advice on the slow, strong building method. Thank you, mate. Shashi says, great overview, Rob. Thank you. All right. Kylie says, I'm trying to keep the turtle in mind, but yes, great advice. Thank you. Tony says, great. Thank you. So lots of comments on great, 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 great. So thank you. That's fantastic, guys. I really appreciate your help. I'm just going to see if I can find a question. So I'm not sure I know how to pronounce this. So if I get it wrong, I humbly apologize. But Harishman says, I have access to 700K cash, but no serviceability. As such, I have maxed out already. I'm looking at dual occupancy subdivision, but I'm lost for direction. Plan is to sell one and live in the other. How do I go about looking for a profitable site? How much for slow housing market? Everything seems too expensive. So there's about 4 questions hidden within that. So I'm just going to answer the first part of the question, okay? So you've got cash, okay? Now cash can go towards the running of the project, can also go towards equity in the actual deal. But you don't have serviceability. So you're basically tapped out with regards to residential lending. Now, as I touched on before, at some point you're going to transition to commercial lending. So I'm going to encourage you to start to look at commercial lending here and say, well, if I do commercial lending, they're not going to look at my serviceability anymore. Instead, they're going to look at the profitability of the deal. If the deal makes sense, they will lend me the money. Yes, there's a higher interest rate, but when they do that, what they do is they capitalize the loan. The interest gets pushed to the tail end. You only pay at the tail end, and it becomes a cost of the project. And so long as the cost doesn't outweigh the profit, it means that it's still worthwhile doing. So start to consider those alternative funding methods. Or alternatively, you might find a joint venture partner who has some serviceability, and the two of you might join forces to actually get together. But that is going to keep you in that residential space. There's going to be some issues and challenges in staying in that residential space for too long. Eventually, you're going to step out of that resi space. So you want to start to think about, well, the next stage on my journey is the commercial lending. What do I need to do to start to learn that commercial lending right now in order to move forward? Hope for that helps. A couple of other people saying thank you very much. So TN, Margaret, Tim, and the like. So that, folks, looks like it's the last question. So based on that, I'm going to say thank you very much for your time. Been a pleasure as always, and looking forward to seeing you at our next meetup coming up, or alternatively at a Sunday session at some point in a place somewhere near you. Till then, bye for now, folks. Bye.